Let's look at accounting for financial instruments under FRS 102. Okay, so as I'm sure you'll all know, under FRS 102, you're applying sections 11 and 12 of the standard in terms of accounting for financial instruments. My sense is that people within industry and practice that work with interact for fairly straightforward organisations. They may have the odd derivative instrument, perhaps a forward currency contract, but on the whole, apart from that, they're normally in section 11 more than section 12 of FRS 102, because most fairly standard organisations, financial instruments will tend to be basic. A really quick reminder of the way the rules work if you're in category basic, section 11. I tend to distinguish in my mind between instruments of a financing or non-financing nature. Non-financing, ordinary common and garden debtors and creditors is transaction price. Investments in shares is fair value through P&L. And you then got loans or financing transactions where we account at amortized cost. I think the sense I've got with amortized cost is if you're borrowing from a bank or borrowing from a related party at a market rate, amortized cost on day one will be what you borrow, net of any material arrangement fee, and the accounting really is very straightforward indeed. As I'm sure you'll have picked up from previous training and reading you've done, where it can become thorny, of course, is when you're borrowing from a related party with a repayment profile mapped out formally over a more than 12-month period, and you're not paying a market rate. And in that case, on day one, amortized cost will become a very strange number. And yes, this is what we tend to refer to in the Trinity as nibbles, non-interest bearing loans, where what you'd need to do on day one in this situation here is essentially look at what a market rate is, take future payments to the lender, discount it back to net present value, and therefore on day one, your credit will be lower than the amount you borrowed. So you might be debiting bank 100, crediting loan 80, and you then get a dangling credit of 20, which if you're incredibly unlucky, might end up in the P&L and might end up getting taxed. That's the issue that's been around ever since 1 and 2 came in, and if anything, probably it's been the most contentious issue of all. The practical something to put on that today, though, is that what I'm kind of finding from the work I do with firms and with companies generally, is that although related parties will often lend to companies at a non-market rate, these loans do often tend to be informal. And if informal, and there's no formal repayment profile mapped out over a more than 12-month period, what you'll essentially do on day one and going forward is include that loan on the balance sheet at its face value. The killer there will be for many organisations that will end up in short-term creditors, but at least you'll not need to worry about doing the net present value calculation. And what I think has been more contentious is the fact that it will be in short-term creditors, even though there's perhaps no expectation on the part of the lender to want their money back anytime soon. And lots of delegates get really grumpy about this on the basis of commercial substance. If there's no expectation for that money to get repaid anytime soon, why not put it in long-term liabilities? What most professional bodies would say in answer to that one would be whether a creditor is due within or more than 1 year is not in any way, shape, or form a matter of commercial substance. It's quite simply a matter of legal fact. At least the good upside is if you're putting it in short term, you're not worrying about NPV calculations and all the complexity, I suppose, that would involve. Here's one note to the accounts that I found last year in the books of a League One football club. What they were doing was borrowing from their parent company quite a significant amount of money. You'll see it here, 87.2 million. That was on an informal basis, legally, and therefore a short-term creditor. And they basically, at the bottom of their creditor's note, specifically commented, the amounts due to the parent company of 87.2 has been treated as falling due within 1 year, as this is the technical legal status of the loan at the balance sheet date. So clarifying very clearly there why that's in short term, and that it's very much on the grounds of a technicality of a legality. And then going on to say, though, that as described in note 1 subsequent to the year end, the parents confirmed that in the previous years, it will provide sufficient finance to support the company for the 12 months following the approval of the accounts. So kind of saying that although that is legally the case, there is, for the avoidance of doubt, no expectation that that money will get paid back anytime soon. But just for clarity, that's why it's in short term. And that, I feel, is quite helpful to make clear why the creditor is where it is. It's still unpopular. You may still well find for organisations which default to that position, as they probably should always have been doing, that it will make a mess of your net current assets. It will make a mess possibly of your credit rating. But that's the way it plays out. And that, I think, is quite helpful to make clear the basis for that inclusion in that particular note. We do get questions from auditors around going concern who say, well, if we're going to put the creditor in short term and that's going to mess up the ratios, will that then in any way, shape or form impinge on our going concern conclusion? I think the one I've got with that one is that going concern is all about looking at pragmatically when the money will flow through the business. So I think the practical point about when the money will be repaid is relevant for a going concern point of view. And you might therefore find in this situation here, from an audit perspective or an accounting perspective, there's not really any going concern issue as such. You may have picked up from the Triennial Review Amendments to 102 a dispensation. This dispensation has been around in a similar format for a year or two. But here we are, as an exception to paragraph 11.13 of 102, the following financial transactions may be measured initially at transaction price. A basic liability of a small entity that's a loan from a person who's in the direct group of close family members when that group contains at least one shareholder in the entity. Yeah, it's a dispensation. It's quite narrow insofar as it only applies to small entities. It only applies to loans from directors or members of their close family. But it will mean whether you or I would need to do a net present value calculation when it's formally repayable in more than 12 months, you would not need to do that. The sense I've had from a lot of people this last 3 or 4 months on course has been that given a lot of these loans are informal anyway, this dispensation will not help. But if you do have formality around that long-term repayment profile and the entity is small and the loan qualifies, you will at least now be in a situation whereby no net present value calculation will be done. The way that was getting covered off before, I think, was to have your cake and eat it, so to speak. So long-term liability presentation with no net present value was let's make it formally repayable in a year and a day on a rolling basis, whereby that's then formally long-term, but the impact of discounting is immaterial and we don't need to embrace it. Now, in that situation there, that would no longer be required. But yeah, I think it's quite narrow, and I'm not sure that's going to have as much relevance as you might think with these Triennial Review Amendments coming into play at the current time. Right, before we move on, if I could just run through 1 or 2 other scenarios, just disparate scenarios that crop up. Here's one. My clients borrowed money for a property development. The loan will be repaid when the property development is sold. The amount repaid will be linked to the sales proceeds. How do I compute amortized costs? We get quite a lot of questions around situations where it's not exactly clear when that greater than 12-month time frame will actually end. And therefore, if you are going to do a net present value calculation, when you NPV it back from, do remember that in terms of basic loans that you use amortized cost for, they will, again, per section 11 of FRS 102, recompense the lender for the time value of money and credit risk. If you're linking the repayment proceeds to what the property development sells for, that's not basic. And that will be fair value through P&L based on section 12. And we do see these loans coming through, and when you've got those sort of features, section 12 is where you'll go. And I guess in that situation, the fair value of the loan to some degree would be linked to what you would expect the properties to be sold for down the line at the point the development is complete. Should consideration be given to the discounting of loans due to members in an LLP, which are repayable only in the event of a member retiring or resigning? This crops quite a lot on LLP courses. My take on this one is that the LLP sort of is very quiet on this whole issue of NPV, and I think possibly yes. But I guess although you might be looking at a fairly young member in an LLP with no expectation on their part to step away and retire or resign anytime soon, if they could do that tomorrow and they would get repaid tomorrow, then that again to a degree I think becomes a repayable on demand liability and therefore no amount to actually discount back from. But I do think the SORP could have been clear on that. It's not clear on that, and therefore in that particular area, do people have questions? I think they genuinely do. But that's my take really in relation to the situation there for LLPs. And the other one, which again crops up surprisingly regularly, interesting one, is thinking about loans from banks which are subordinated or postponed. Okay, so we've got a very informal director's loan, let's say in a medium-sized entity, repayable on demand, therefore ostensibly short-term creditor. The bank then lends to the entity and says, we're not happy for you to have that loan repaid until we're out. And if they're out in 5 years, are we then looking down the barrel at an NPV calculation and the amortized cost calculation again becoming a bit complex? I think potentially, and this has cropped up really a lot ever since the start with FRS 1 and 2, a lot of people I've spoken to, though, that have got this issue tend to look at it from the point of view of saying, well, who's actually agreed to the postponement of subordination of that loan? If it's an agreement between the company and the bank, the director could step in tomorrow and say, no, I want my money back. And if that were the case, what the company would have to do was go to another external source to borrow money to then afford the repayments, in which eventuality it's still a repayable on demand loan. Whether I think there's a tripartite agreement between the company, the bank, and the director, then that would change the game completely. That would mean it's a long-term liability based on what legally can happen. And yeah, going back to the earlier point I made, if that entity was a small entity, no need to NPV it. If it were a medium entity, it would be an issue. And that, again, I think has been quite a tricky one. A very common issue, of course, in many straightforward owner-managed entities that we come across. That's accounting for financial instruments under FRS 1 and 2.